Here is a macro view of the market. It's really the Dow Jones Industrial Average over the last 70 plus years. And you can see that the stocks go up and they go down, up and down, up and down. Every year they're up and down, highs and lows all during a year. But over the course of time, from the 30s all the way till now, they basically have just gone up. Just goes to show that if you invest in stocks of good, solid companies that stay in business over the long haul, that maintaining those good quality companies over the long periods of time, you'll eventually increase in value. But if there's anybody out there who's ever bought a stock and lost money in that stock because they sold it for a loss, you have to ask yourself why. There's a reason why people actually lose money in the stock market. It's when they decide to sell a stock for a loss. They make that decision. They know how much they paid for the stock, and then they tell somebody or do it themselves and say, sell it for less than I bought it for. Guaranteeing. Every time you do that, I can guarantee that every time you sell a stock for less than you paid for it, you'll probably have a loss. Now, there's three main reasons why we say that investors lose money in the market. The first one is excess trading that's encouraged by the brokers. Now, the second reason is really applies to retirees very well, myself included. It's when you're retired or you might need the income from your portfolio to pay your bills, your electric bill, your utilities, your mortgage, your car payment, school expenses, whatever. The last one we call chasing the trend. That's what the majority of people do. They end up listening to the hype, buying into the top of the market, and then it turns around with a correction. They panic and start selling. But this buying high, selling low, this chasing the trend mentality has cost investors billions of dollars over the years. Here's a really interesting statistic. The average stock mutual fund over the last 20 years has averaged a 13.2% return per year. But the average investor in those mutual funds has only earned about 4%. Now, how's that possible? That mutual funds generating 13%, but the investor about 4%? That's because of chasing the trend. So now things that you need to think about. In your portfolio, do you need it to grow so that it can get larger and larger so that eventually you can retire? Or do you need current income for living expenses and or because you're in retirement and that you need the cash to live on? Well, there's a solution that allows both the consistent monthly returns in your portfolio and you can take some out to pay for your expenses. And that's regardless of the market direction, whether the market direction is going up or whether the market's going down. It's writing cover calls the correct way. That's a solution to do that. And at Compound Stock Earnings, we teach you the correct way of writing cover calls, because there is an incorrect way. Teaching somebody how to buy a stock and sell a call, that doesn't take very long, and it's real easy to teach someone how to do that. But most other seminars of other companies that mostly have gone out of business over the years, they didn't have any management techniques that could take care of generating income on stocks if they were declining after they were purchased. We do at Compound Stock Earnings. We will teach you those throughout the course of these 2 days. So a cover call is you buy a stock, say at $20, and you sell an option to someone to buy the stock back from you at $20. They pay you $1 a premium and you make 5%. If the stock goes above 20, you sell the stock at 20, same as what you paid for it. You take that cash and go do it again. If the stock starts dropping, where the next month it's only at $19, well, you can't get $1 to sell the 20 option again. You have to sell the 19 option to get that $1. So other seminars will teach you, don't just keep dropping that strike. If the stock keeps dropping, just drop the strike so you can keep generating income each month. Then it goes down to 18, down to 17, down to 16. So now you've sold an option to someone to buy your stock at 16. Remember, you paid 20 for it. All of a sudden, it shoots up to $18 and you get called out and you sell your stock at 16, even though you paid 20 and you lost money. That's the wrong way to do cover calls. That's not the way we teach you to do it. We're going to teach you management techniques where you never sell your stock for a loss, but you can keep generating income month after month after month. We're going to talk about an introduction to options. So I'm going to go through what options are, all the basics, how to use them. Selling options against a stock that you own actually lowers the risk of owning that stock. It minimizes or eliminates risk altogether. That's what we're going to teach you to do. Now, options originally were not devised for speculation, although that's how the majority of people that buy options today are speculators, hoping that they're going to go up. If you decide to invest in the stock market and you buy stocks, you are risking your money on the stock. Selling the option against that stock is no risk. That's just guaranteed money coming in. As long as you do it the right way and calculate it correctly, we're going to teach you how to do that. But it's the writing of the covered calls that generates that monthly cash flow.